This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
I have Ronald Peter Stoeferle joining us from Vienna here this morning. Ronnie has been on Macro Analytics previously discussing financial repression. He is a noted Austrian economist and money manager with Incrementum based in Liechtenstein. Welcome back, Ronnie.
Hi, Gordon. Very good to see you and happy holidays, or as we are saying here, frohe Weihnachten.
Oh, good. Thank you very much. And a Merry Christmas to you, too. Ronnie, maybe we could begin with you giving our listeners a brief overview, because we've got so many new listeners now joining us since you were last on. But your background, the In Gold We Trust report, which you were very, very well recognized for.
Yeah.
I see you have a new book out, and also exactly where is Liechtenstein?
Liechtenstein is basically in the middle of Europe. It's very close to Austria and to Switzerland. It's a tiny country, only 35,000 people. Very much orientated towards the Austrian School of Economics. So Prince Hans Adam Liechtenstein, he's a keen follower of the Austrian School of Economics, and it's a beautiful country in the middle of the mountains. Just a little background on myself. I used to work at Erste Group, did research on commodities, especially gold and oil, for 7 years, and I started writing the yearly In Gold We Trust report 6 years ago. And 2 years ago, I quitted my job and set up a new company together with some gentlemen mostly from Switzerland. And I launched a fund that invests on the premises of the Austrian School of Economics. So what we are currently developing is what we call Austrian investing, combining the macro views of the Austrian School of Economics with asset management. And that's what we also wrote a book about. It's called Austrian Investing Between Inflation and Deflation. Unfortunately, only available in German at the moment, but we are working hard on the translation, and it will be out probably in the first quarter of the next year.
It's really hard to find Austrian economists who understand Austrian economics as well as you do, but also have solutions and ways of investing using that thinking in this area. We've been doing, as you well know, a lot of work on financial repression, and we're now really shifting to people who have solutions to this problem, to this dilemma, which you clearly have. Now, Ronnie, you've been calling for gold. Well, I should say everybody should read In Gold We Trust. It's mandatory reading for anybody interested in precious metals and gold. But you're calling for gold of $2,300 an ounce U.S. in the longer term as really this investment dilemma for investors continue. Now, you brought some outstanding slides with you this morning to talk about monetary insurance, and I want us to jump right into them so we don't run out of time.
Sure. I think in general, having a look at the 1 year performance in euros and in dollars, it's quite astonishing that even in US dollars, the performance is more or less flat. But in euro terms, and that's what our clients mostly are interested in, the price of gold is up by 10%. And gold in most of the other currencies, except the US dollar, looks also very strong. So it's also very much a function of an extremely strong US dollar that we're seeing. Now, given the fact that the sentiment at the moment is horrendous, there are no gold bugs around anymore. There are no nobody is bullish on gold anymore, and that makes me very, very confident, because the charts are already telling that we might be on the verge of the end of this correction phase. Now, from
Our
my
chart,
point of view,
Ronnie, our charts, we do a lot of work technically at triggers.ca with some very sophisticated technical analysis. And our charts are saying we're at the end of a 2-year consolidation wedge. We actually have some early signals that say in silver and gold we might be seeing preliminary breakouts, but I won't call that yet. But we're very much near the end of it. It appears there may be another down, a little bit of a down wave in here before we finish it, but we're nearing the end.
A very experienced trader once told me that the market tends to maximize pain, and I think we're very close to it. And I have had really a number of conversations with very frustrated gold investors, and I can tell that especially the institutional clients that we're talking to, nobody's interested in gold anymore because, as I would put it in one sentence, it's a bull market in greed, but a bear market in fear at the moment. So
Precisely.
if you're fearful, you want to have at least a certain allocation to gold. But at the moment, everybody is mostly greedy. However, having a look at the macro picture, it seems that there's really lots of things going on, obviously, and I think 2050 will be an exciting year for macro investors. It will be volatile. There will be plenty of opportunities, and I think gold is one of the biggest opportunities going forward.
Everything indicates to me that the central banks, in fact, will have to print more money. Liquidity is actually drying up significantly, at least the rate. And additionally, with the oil plunge, it has pulled close to $500 billion of liquidity out of the market, out of the asset markets. So when they start to signal more money printing, if I could, or at least expansion of the balance sheet, I think that'll start in EU first. I can see the precious metals starting to gap open in fairly large amounts on certain days. I could see $100 moves in gold. The charts are suggesting it's very coiled, but it won't come until the central banks really capitulate here.
I totally agree. I think that, I mean, having a look at the big picture, we're seeing that the US dollar index closed at the highest level since 2006. So we're seeing a major bull market in the US dollar, which also kind of means that the whole world is scared of deflation at the moment. So we are bringing back money to the US, to the allegedly safe haven. The US Treasury curve is now the flattest since the Great Recession. That's a very important fact, and it shows that the spread between the 30-year bond yield and the 2-year note is the flattest since the Great Recession. It's a very interesting point. I think at the moment we have to ask ourselves, why is the US dollar that strong? And why are especially emerging market currencies that weak? I think the fact that everybody expects the US, the Federal Reserve, to start hiking interest rates probably in June or July of next year. That's the prime reason, because everybody thinks that this differential in rates will increase. From my point of view, having a look at the FOMC, for example, right now we have the most hawkish FOMC in a very long time. This will change. So by the beginning of next year, Charles Plosser, but also Richard Fisher, who are very hawkish, will be replaced by doves. So from my point of view, the fact that we are seeing disinflation in the US now as well, due to the very low oil prices and energy prices, this will be a trigger that the FOMC will probably stay more dovish than the market expects now, and they will delay the rate hike further. And this might also mean that the US dollar will probably be weaker as the market expects. Just one very important point. I recently attended a conference. Very, very,
We're
yeah,
on that. Ronnie, believe exactly what you just said. Saying we think that Britain will defer first, and then the U.S. will come off that spring expectations as it tries to fight the rate of deflation to push up inflation rates. And
exactly.
it's got to do it. It's right now. It's hiding a little. It's good cover as before they come out with. It won't be called quantitative easing 4, but it will arrive to offset this rate of inflation.
Yeah, totally.
Or perceived.
Perfect. Yeah, absolutely. One very interesting point about sentiment. I recently attended a conference with very sophisticated investors, and they always do a survey at the beginning of the conference. So they asked those 200 money managers managing trillions of dollars for their clients, what do you think will be the strongest currency in 2015? And 83% of the people said it will be the US dollar. So there's already a lot of optimism and bullishness priced into the US dollar. Basically, every outlook by the major banks says that the US dollar will be the strongest currency next year because they will hike interest rates. That's already priced in from my point of view. And the fact that due to this very strong disinflationary move that we're experiencing now, this will put pressure on the central banks that they will announce something. I mean, having a look at the Eurozone, Mr. Draghi, he's now openly saying that they will also probably buy government bonds. They said they will basically buy everything but gold, which is pretty interesting. But I mean, 2 or 3 years ago, if the head of the European Central Bank would have said that they will act out of their mandate, that they will do something that they are basically not really allowed, meaning buying government bonds, I think it would have been a huge discussion. But now this whole deflationary, how should I put it, pressure or threat, this gives them definitely leeway to introduce measures in very big sizes and enormous amounts. And this is really one of the key things that I always want to present our investors. You cannot control the dynamics of inflation. Looking back into history, there were a number of episodes of high inflation and hyperinflation. And 1 or 2 years ago, central bankers and politicians always said everything is in order. We will stop the printing presses as soon as inflation rates go too high. They never did. So I think that's a very thin line that we're walking at the moment between inflation and deflation. And one more anecdotal evidence I saw on Bloomberg recently. The headline: bond investors are writing off inflation for years, if not decades to come. So deflation is the consensus trade at the moment. Nobody believes in inflation or rising inflation rates, and that makes me very, very confident for gold and mining equities.
You have some other slides that you wanted to show us.
Absolutely, absolutely. Now,
that
having
really
a look,
demonstrate this, that really show your thinking.
Having a look at the performances, for example, stocks versus gold in local currency, you can see that gold did pretty well, although it took a beating in the media. So in local currency terms, especially in Russia, for example, gold did very well. We're also seeing that the average annual gold price is
Ronnie, I apologize for interrupting. Will Putin sell his gold as he's trying to protect the ruble and he's running out of currency reserves other than U.S. dollar, rather than gold?
I think that would be the most stupid thing that he could do. And I don't think that Putin is a stupid man, so I don't think that he's going to sell any gold.
So how will he protect the ruble? Is he going to get swaps out of China?
I mean, they've got more than I think 500 trillion US dollars in reserves. So 500 billion, sorry. I think this may last for the next
Okay.
two years. I think it's sufficient. I think the whole ruble crisis is. We have already seen panic. The market was panicking, the media was panicking. So I think that we have seen the worst for the ruble so far.
Yeah, only reason I brought it up, a lot of gold investors are watching that pressure, and as oil falls and Russia's 80% economy dependent on energy, whether he'll be forced to do something with the massive gold reserves he's built up. It's my opinion, the same as you. He will not sell them. That will not happen.
Exactly, and what I also want to show your your listeners and your watchers is, first of all, the average annual gold price, and you can see from this these annual average prices that, okay, we have seen the high in the average gold price in 2012, not in 2011, but so far nothing really happened. So I think there are not so many people that really bought at an all-time high at above 1900. So from my point of view, it's a very normal and also healthy correction. Like, you know, people here in Austria and in Liechtenstein, they love climbing the mountains, and it's like, if you climb the mountain or run up the hill too fast, you have to take a breather. That's just normal, and it's the same for gold. Now, what I think is very interesting. I brought up the reasons why gold is trending sideways or lower. First of all, it's disinflation and it's rising real interest rates. But we're also seeing that we're seeing massive deflationary pressure at the moment from commodity prices. We're seeing it in an extremely strong US dollar, and we're seeing that that the market is getting a bit more nervous again, but not probably so nervous that it starts piling into gold again. But I'm seeing increasing signs that this big sell-off in oil will have collateral damage on other asset classes, for example, junk bonds, but also emerging market countries like Nigeria. Have a look at the Nigerian currency, for example. So we're seeing lots of collateral damage, and the effects will probably be seen only in a few weeks or even months. Now, I think a very interesting point is talking, you know, about market psychology and so on. As I'm showing with this chart of Ben Bernanke wearing this Superman outfit. The market has an extremely high level of conviction in the ability of central bankers to get it right. Mario Draghi is only called Super Mario here in Europe. So everybody believes in our central bankers that they did the right choices and that they will do the right decisions. I don't think so. Reading history again, I think they will regret what they're currently doing and what they will be doing very, very soon. And we're already seeing massive asset price inflation. So everybody saying that there's no inflation never had a look at real estate prices, at the art market, for example, or in the supermarket. So there is inflation. It's mostly asset price inflation at the moment, and there will be price inflation sooner or later.
A separate question, Ronnie, is there a chance that we may see a Minsky melt-up in asset prices when this printing resumes, which it will?
Sure. The thing with black swans and Minsky moments is you cannot predict them. So they will come out of nothing. But I think one of the most interesting things that one of my good friends, Simon Mikhailovich, very interesting person, once said, normally in a crisis, you want to decorrelate the system. So to make the system more anti-fragile. what we are seeing since 2008 is that the system became even more interdependent, more correlated, and the whole debt situation is even worse than back in the days. So the next crisis will make look 2008 like a kindergarten party, probably. Yeah, the dimensions.
James Rickards is arguing the same thing. He says the level of complexity that's went into this issue under this current state and the fragility of the global financial system, that the next fracture that will be global, and that's more difficult. You don't have the Fed that can jump in like in 2008 because it becomes around the globe, and how do you fix it? So, but something will snap, and then the contagion starts. Some kind of counterparty failure it's almost to be expected. It's actually quite normal for that to happen. I think what isn't normal is the degree of leverage and debt that's pyramided without any kind of safety net we've never seen before. And having such protracted free money for such a period of time has put so much malinvestment, mispricing, and lack of price discovery that's a terrible concoction of witch's brew we have formulated here.
Absolutely. On the chart that I'm showing here, this is the total credit market debt owed, GDP, and the monetary base. I think very, very interesting. We have seen basically since 1971, because that's where most of my chart starts, this is the beginning of a new monetary regime, new monetary era. Since that, we have seen massive debt-induced growth. So this total credit market debt owed, it used to double every 10 years. But at the moment, and this is our systemic problem that we're having currently, we are seeing that it's pretty tough to increase and to build up further leverage. So the system wants to deleverage, to deflate, but we're seeing policy-induced inflation. And this is what we are describing with this monetary tectonics picture. So I think the fact that at the moment we're seeing massive deflationary pressure, and we just cannot allow in our monetary system deflation to happen. This will be the reason that central banks, they will try out new policies in enormous sizes that we cannot imagine at the moment, probably. I mean, it's already, they're saying in the Eurozone, it will be roughly 1 trillion euros per year. Who would have expected something like that a few years ago? So the policies that will be introduced going forward, they will be of enormous size, and nobody can imagine it at the moment. So
for years, for centuries, deflation was more the normal than inflation until we went into an era of central banks. And as your charts show, all your charts are since 1971, when we went off in August, when we went off the gold standard, at least in the United States, and therefore the explosion in fiat currencies, non-backed currencies, really took off. And that is the core problem with when you don't have sound money.
Yeah, absolutely, I totally agree. And that's why I think that, you know, macro investing is more important than ever. You have to understand the big picture going forward. It's not like back in the days when you said buy and hold for equities. It's getting more and more important to listen and to anticipate what central bankers do and what they say. That's definitely a sign of a sick system, because, you know, 30 years ago, people didn't have a clue who's sitting in the Federal Reserve now, and they were not important for the market. But nowadays it is, and that shows you that you have to have different indicators at the moment. And what we are doing is we created our own proprietary inflation signal that just shows us, do we see rising, falling, or neutral inflation? And this is based only on market indicators. So we don't use any government statistics because they're basically useless. So since the beginning of August, we are seeing massive disinflation, and that's also what we are investing in our fund in. So At the moment, we don't own any inflation-sensitive assets at all, but it will be a great entry point as soon as our inflation signal says rising inflation again. We're definitely a bit away from that. But I think the momentum of inflation and the direction of inflation is really something that every prudent investor has to look at these days.
You know, it's really you're mentioning the distortions and what's come to the system. We're talking here about how deflation is absolutely what the government and the banking system does not want. It's terrified of, and inflation or 2% inflation is what we want. Inflation is not good for the average person or the citizen. It is not. Why we need deflation is because anybody that's got excess debt vis-a-vis the government, or anybody that's highly leveraged with debt is exposed. So really, the reason we have to have inflation is to protect literally a collateral implosion of excess debt. But it's not going to help any single individual. Matter of fact, it's going to destroy their purchasing power, which is effectively wealth.
Totally agree. And one way to secure or to even perhaps to raise your purchasing power is, of course, owning gold. I mean, it's tested by the market and market participants for hundreds and thousands of years. And I don't think it's a coincidence that during this trial and error process, only gold and silver survived as monetary metals. It's not cigarettes or goat skins or salt. Used to be currencies for quite a while, but at the end of the day, it was only gold and silver and not paper, obviously. So,
it's historically always been this way. It's historically, there's never been fiat currencies that have ever survived because they always end up with excess debt. And in fact, they collapse. And it's not that you make money, in my mind, correct me if I'm wrong, on gold and silver. It's that you store your value or you store your wealth. You have insurance. It's your insurance against this flood of debt and buildup and increasing credit and expansion of the monetary system, which we now appear to be trapped and can't get out of.
Totally agree. And I want to show you another chart. It shows gold during currency crisis. Mm-hmm. And Mexican peso, Indonesian rupiah, Russian ruble back in the days, but it's basically the same picture now again, and in Korean won. And it just shows you that you need this monetary insurance before the accident happens, obviously. Yeah? And this can happen very, very fast, as you can see on those charts. And
so you can't don't buy insurance when it's starting to rain and the flood is coming in. It tends to get very expensive then, doesn't it?
Exactly. The premiums tend to rise then.
Before you know it, and extremely fast. So you've got to sit down and really look at the weather forecast and say, is there a higher chance that they're going to increase liquidity and balance sheets or less based on what you see in Main Street versus Wall Street? I think that it's as simple as that, is it not, Ron?
Absolutely, absolutely. And I think, timing the market is really hard. And I'm not 100% sure if it's possible. But a colleague of mine...
Especially in a market that may be manipulated, too.
Exactly, exactly. There's perhaps one free lunch for investors, and that's diversification. And, at the moment, and I think this is just a beautiful quote by John Templeton, he said, bull markets are born on pessimism, they grow on skepticism, mature on optimism, and they die on euphoria. The time of maximum pessimism is the best time to buy, and the time of maximum optimism is the best time to sell. As you can see on these charts here, we're seeing for the gold box index, representing the mining stocks, excessive pessimism. So nobody is bullish on mining stocks anymore. And silver is even more contrarian. So going back to Templeton, the time of maximum pessimism is the best time to buy. I think he wasn't the worst investor, so we should follow his advice, obviously.
But he also didn't live in a time when the powers to be had a vested interest in destroying the price of anything that competed with the fiat currency, vis-a-vis anything that stores value effectively, such as gold and silver. So if there's any kind of manipulation going on between physical and paper, you are exposed with this game going on. There is risk there.
Absolutely, and that's why I'm always recommending, if you want to have exposure to gold, buy physical gold, buy physical silver. Don't buy any ETFs or certificates and stuff. If you want to have real leverage on gold, on the upside, but also on the downside, obviously, buy mining stocks, gold, silver stocks, for example. But if you really want to buy monetary insurance, buy physical gold. That's the main message.
Mm-hmm.
Another very interesting point is, because I was referring to the direction of inflation before. Having a look at the big bull market in the 70s, we can say that there was a massive correction from 1974 until 1976. What we experienced during this time was massive disinflation. So inflation rates were above 10%. I think they were 12 or 13%. And then we had disinflation for 2 years down to 4%. Now, on an absolute level, 4% might sound high, but it's only the direction that counts. And this was very, very disinflationary. And we have seen a collapse in the price of gold between 1974 and 1976. It almost halved. So having a look at the chart before, seeing that we're seeing disinflation and the falling price of gold, okay, this kind of confirms the picture. And it also means that as soon as the inflation trend will pick up, and it will pick up sooner or later, this will be probably the time that the bull market will start again. Now, what we are looking at quite a lot is the so-called gold-silver ratio. It's showing us the direction or the purchasing power of gold versus silver. And at the moment, this ratio is rising, meaning that gold tends to outperform silver at the moment. This also means that we're seeing this deflationary trade, because silver is more of the inflationary metal. I would say that silver is even a better indicator for the economy and inflation than copper, Dr. Copper, as it's also said. So having a look at the gold-silver ratio gives you a lot of information, and as soon as this gold-silver ratio turns, it will also mean that inflation will be priced in again. So have a close look at the gold-silver ratio. Very, very important indicator.
Ronnie, we have to break. We're out of time. Any last key messages you'd like to leave with our listeners?
Well, first of all, Merry Christmas, frohe Weihnachten again, happy holiday season. It will be an exciting year. It will be volatile, but I always tend to say to our investors and people at presentations, hope for the best, but prepare for the worst. And as I've said, physical gold is a very good insurance in this whole mess that we're in, and that will probably get worse going forward. But I think there's plenty of opportunity going forward, because probably 99% of the people don't realize what's going on in the economy. They've got no clue about the Austrian School of Economics and the insights of the Austrian School. So reading books, Mises, Hayek, there's plenty of web pages dedicated to Austrian investing nowadays. It definitely gives you additional insights that are quite important these days.
Absolutely. And as we said earlier, the time to buy insurance is when it's cheap and the storm has not arrived. But I do need to quote Nick Barishoff in Canada at the Bullion Management Group, and Nick says you should always have 10% of your portfolio in gold, are silver, precious metals. But today, because it's so strategic for the reasons, fundamentally we've been talking, it should be 20%.
Yeah.
But even within that 20%, it should be diversified: gold, silver, platinum. But
Yeah.
but even then, he says, look, I still say it maximum 20%, because there's other way. The Austrian school, the other 80%, there are other ways of also investing to protect the store of value. It's that diversification. Would you agree with me? That's so critical now. And I know you have solutions other than just looking at precious metals.
Yeah, I think there's plenty of opportunities to invest based on the Austrian School of Economics. What we are doing is we're actively timing inflation-sensitive assets. So for us, it's only important in which direction inflation is trending, and then we're investing based on that. There's also one beautiful concept by Harry Brown, who was really well known in the 70s. It's called the permanent portfolio. 25% of your portfolio in gold, 25% in equities, 25% in bonds, and 25% in cash, and then rebalance every year. So this is a very, very basic concept that every investor can follow very easily. And there are, of course, different aspects of this concept, but I think it makes sense, because honestly, as long as I'm doing my job now and being in research before, it's really tough to forecast the market. So being diversified and also insured for episodes or things that you didn't expect definitely makes sense. So I think based on Austrian investing, there's a number of different aspects. As I've said, our book will be out in the first quarter of the next year, and we will write. We have written roughly 400 pages about those concepts that are definitely giving you a different and a new view on the market. Because based on the Austrian investing philosophy, our monetary system is the starting point, and this will become more and more important. This top-down view that the Austrian school provides.
I recommend to all our listeners to go to your site and to look at two of your articles are in Gold We Trust. I shouldn't say articles, reports, and your work and slides on monetary tectonics. We didn't have time to really delve into it here today, but it really lays out this tug of war between inflation and deflation, what the elements are, to really get into the signals that as you pointed out here earlier, that can start to tell you when it's turning and therefore what's going to happen in the precious metals market. Ronnie, we have to break. Thank you very much for your time. Always great discussion. Always appreciate your slides, and the best of the season.
Thank you very much. All the best to you and your listener. Take care. Bye-bye.
Talk to you in the new year.
Thank you. Happy New Year. Bye-bye.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.